Hey, it's Darius, and we got a huge special going on to introduce I-75 CMA exam. Click here for those testing before June 28th, and here for those testing September 2024 or after. It's just $89 a month in our huge introductory special. And of course, like I-75 CPA review, you can cancel anytime or reach out to me and I'll cancel for you personally. I-75 CMA is everything you need to pass part 1 of the CMA exam. Look for a link in the description in this video, and then get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. All right, what do we have to know about stockholders' equity on the balance sheet? So according to the basic accounting equation, equity is the residual when total liabilities are subtracted from total assets. On the balance sheet, the major items of equity fall into two categories: contributed capital and earned capital. Contributed capital includes common and preferred stock, and they get recorded at par value. The excess gets recorded as additional paid-in capital. So you should know that contributed capital includes common stock, preferred stock, and additional paid-in capital. Then there's earned capital, which is retained earnings, another stockholders' equity account. Retained earnings, which is accumulated net income not yet distributed to owners in the form of a dividend. Dividends are a distribution of earnings to the stockholders, and dividends reduce retained earnings. Any payment to owners in excess of retained earnings is a return of capital, not a dividend. A dividend needs to have earnings associated with it. Otherwise, if the distribution is in excess of earnings, then that distribution is a return of capital and not a dividend. So earned capital includes retained earnings, contributed capital includes common and preferred stock, and additional paid-in capital. Another stockholders' equity account that you need to know something about is Treasury Stock. Treasury Stock is a contra-equity. That means the opposite of equity. Treasury Stock is the company's own stock that had been issued, but now is being repurchased. Therefore, Treasury Stock is going to reduce total stockholders' equity. That's why we call it a contra. Contra equity means it's the opposite of equity. The purpose of Treasury Stock is to hold shares for retirement or potential resale. So the company that buys the Treasury Stock back will either retire those shares or they'll hold on to them, and then when the price of the stock goes up, they might resell them then. Let's try this. Which of the following stockholders' equity accounts represents the cumulative earnings of the company that have not been distributed as dividends? Would that be common stock? Well, common stock is a stockholders' equity account, but no, it wouldn't be common stock. Preferred stock. No, preferred stock is a stockholders' equity account, but that doesn't represent the cumulative earnings of the company. Additional paid-in capital, APIC? No. D, retained earnings? Yes. Letter D is correct. The account that represents the cumulative earnings of the company that have not been distributed as dividends is retained earnings. Retained earnings accumulate the net income, the profits of the company that have not been distributed to the shareholders in the form of dividends. Retained earnings reflects the company's total earnings retained for future use, reinvestment, or to cover future losses, or to pay future dividends. What is the purpose of Treasury Stock in a corporation? A, to increase the number of outstanding shares. No, just the opposite. If a company buys back shares in the form of Treasury Stock, that reduces outstanding shares. B, to provide additional voting rights to shareholders? No. Treasury Stock does not get a voting right. C, to hold shares for potential resale or retirement? Yes. D, to pay dividends to shareholders? No. Dividends are not paid on shares held in the Treasury. Dividends are not paid on Treasury Stock. So the answer is C. The purpose of Treasury Stock is to hold shares for potential resale or retirement. Treasury Stock represents shares of a company's own stock that have been repurchased and are being held by the company itself. These shares may be later resold to raise capital if the stock price goes up, reissued to employees as part of a stock-based compensation plan, or the shares can be retired and taken out of circulation. Treasury Stock is not held to increase the number of outstanding shares, A is wrong, or to provide additional voting rights, like B says, or to pay dividends to shareholders, like letter D. Its primary purpose is to potentially resell the stock or retire the shares. Letter C is correct. How about this? In the stockholders' equity section of a balance sheet, what does additional paid-in capital represent? A, the face value of issued stock. No, the face value of issued stock would be the common stock or the preferred stock. You're talking about the number of shares now times the par value. That's the face value of issued stock. B, the excess of amounts paid over the par value. That's additional paid-in capital. B looks good. C, dividends declared but not yet paid. No. D, long-term debt. Long-term debt's not even in the stockholders' equity section of the balance sheet. Long-term debt's in the liability section. Letter B is correct. Additional paid-in capital, known as APIC, represents the excess of amounts paid over the par value of stock. APIC is the amount that investors have paid for shares above the par value. And there can be APIC on common stock. There could be APIC on preferred stock. This can happen whenever a company issues stock at a price higher than the par value, and that's quite common. All right, which of the following is not a component of stockholders' equity? Common stock is. Treasury stock is, even though it's a contra-equity. Long-term investments, yeah, that's an asset on the balance sheet. That's not stockholders' equity. D, additional paid-in capital, that's equity. So the answer is C, long-term investments are not a component of stockholders' equity. They're classified as assets on the company's balance sheet. Equity represents the owner's claim to the assets of a company after all liabilities have been deducted. And equity, we know, is composed of common stock, additional paid-in capital, retained earnings, and treasury stock, even though treasury stock is a contra-equity. So C is the answer. It's not a stockholders' equity account because long-term investments represent the company's investments in stocks, bonds, or other financial instruments that are expected to be held for more than 1 year, since they're long-term here, and are not directly related to the equity provided by shareholders. With long-term investments, the company had some excess cash and they invested it long-term in securities, stocks and bonds of other companies. How about this? If a company has $200,000 in common stock, $100,000 in retained earnings, and $30,000 in treasury stock, what's the total stockholders' equity? Well, you would add common stock, you would add retained earnings together. That's $300,000. But don't pick B, because there's $30,000 in treasury stock, which has to be subtracted since treasury stock is a contra-equity. So the answer is A, $270,000 is the total stockholders' equity. How about this? A business entity has disclosed the following balances in its financial statements. And what do they want to know? What's the total stockholders' equity reported on the balance sheet? So you got common stock, $400,000. Is that stockholders' equity? Yes. Retained earnings, $250,000. Add those two together. Treasury stock, subtract $50,000. You're at $600,000 right now. Are we done? Is the answer A? Not so fast. We got all these left. Equipment, that's an asset. Don't include that. Notes payable, that's a liability. Don't include that. Inventory, asset. Don't include it. Additional paid-in capital, $150,000. Add that. Accounts payable, liability. Don't include that. So we're up to $750,000, and that's choice D. All right, which of the following stockholders' equity accounts represents paid-in capital as opposed to earned capital? Well, most stockholders' equity accounts are either paid-in capital or earned capital. Paid-in capital is common stock and additional paid-in capital. Earned capital is retained earnings. So what are we looking for here? We're looking for paid-in capital as opposed to earned capital. So retained earnings, letter A, that's earned capital. Don't pick A. B says retained earnings too. That's earned capital. We want paid-in capital as opposed to earned capital. C, common stock and additional paid-in capital. Yes, that's considered paid-in capital. Paid in by the investors. D says common stock only. No, it would be common stock and additional paid-in capital. Also, preferred stock would be paid-in capital too, and so would additional paid-in capital preferred. So the answer is C. Retained earnings represents earned capital, as retained earnings consists of the earnings retained in the company, not distributed as dividends. Common stock and additional paid-in capital, they represent paid-in capital because they both reflect the amounts paid in by investors to the company when they purchase the company's stock. Therefore, the answer is C. Let's try this. On the balance sheet, which of the following correctly describes preferred stock? If you think you know, leave me the answer in the comments section. And remember to like and subscribe because it really helps the channel out a lot. And if you need more help with CMA Part 1, go to i75cpareview.com and click on CMA. It's only $89 a month. And you can cancel anytime. Just reach out to me. I'll cancel for you personally. If you're testing before June 28th, 2024, click here. For those testing September 2024 or after, click on the right. I'll leave a link in the description, but get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference.